Hey, this is Mark from Caliber Home Loans. Happy Sunday. Hope this video finds everybody safe and sound. Looks like the state's going to reopen maybe on the 15th of May. There is a couple of proposals that have been sent to Lansing to ask the governor to move real estate realtors to essential workers. So we'll have to see how that works. But hopefully we'll have some evidence of some movement in this coming week. So I'd like to go over the markets just quickly. So again, the Fed is the major buyer in the bond market. What the graph you're looking at is on Friday's graph. So although it looks like there's a lot of movement, you got to look at the price differential. The price only went from a low of 3.9 to 4.2. So not much of a movement. So the Fed, again, is pretty much the only buyers of the bond market. It is what it is. They're going to continue to buy bonds to help stabilize the markets until the economy gets back on track. So, and again, I just want to emphasize that the rates within the bond market are not showing up on the rate sheets of most lenders because of liquidity issues. There was some movement last week to make it a little bit easier on the conventional side for servicers, but they're still a little bit off. Washington still has a little bit more work to do. Services are still going to get hammered for 3 months worth of payments at a minimum. So remember, if you stop making your mortgage payment, the company you pay still continues to pay Fannie or Freddie. So that becomes a problem, So money's going out, but it's not coming in. So there's still no liquidity facility set up for the servicers, for the non-bank servicers. The banks have liquidity, can access liquidity by going to the Fed and borrowing short-term at really low interest rates. So again, let's look at the market. So this was Friday. Not much going on. There was the Fed was in a couple of times on Friday. They go in 2 to 3 times a day, and they buy bonds just to keep the pricing somewhat consistent. So let's look at the previous week. You'll see that again the low was 3.5 and the high was 4.2. So again, not a big spread, but it's keeping the markets consistent. By keeping rates somewhat consistent, it's actually easier for lenders to close loans and actually make money on those loans. So when they get ready to sell them off to the agencies, to Fannie and Freddie. So let's take a look at the last month. So this is back from the 24th of March. Except for this peak here, it's been pretty consistent. I mean, if you draw the line, it's been a fairly consistent line as we go for almost the whole month. And this goes back to the 19th. This is where the Fed started to buy bonds. So you see this immediate increase in pricing, which dropped rates a little bit. And that was on the 19th of March. And this is the 23rd of March. So again, once the Fed was in all in, the line's been pretty consistent. So that's what the Fed is looking for. So next week brings some different reports. Of course, Thursday is the weekly jobless claims. We'll have to see how that works out. We've been, whatever number they've been targeting, it's always been more than that. So there's more than 26 million people out of work. We think that there could be as high as 10% or more mortgage holders that will go into forbearance. So think about that. That's a huge number. And then that's pretty much the big number next week. The Fed is going to have a meeting next week. We don't expect them to move rates. I think they're pretty much done moving rates unless they don't really have much more to move. They're not going to go negative. So it's important, but it's not as important as it might normally be. And really the only other news that's coming out next week that may move rates a little bit as consumer confidence comes out on Tuesday. We expect consumer confidence to be down just because of the environment. And then the core inflation rate, we expect to be up a little bit, but not really. The price of oil took a deep dive. Not that any of us can take advantage of it, but so that does play into the inflation numbers. But there's other food items and stuff that have actually gone up in price, and some other items have gone up in price because of lack of availability and whatnot. So, but again, the overriding impact on the market is the Fed buying. And as long as the Fed continues to buy at the rates they're buying, it will keep the markets pretty consistent. So just real quick, I want to talk about program changes and what I'm seeing with different lenders. So I'm seeing a continuing tightening of requirements from different lenders, and it's really lender by lender. The agencies aren't really doing much tightening at all. It's the lenders themselves that are tightening their restrictions. Credit scores are going, minimum credit scores are going up. Debt to income ratios are coming down a bit. Some lenders are increasing the minimum amount of down payment on their programs, especially on the conventional side. FHA, they're not messing around too much with down payment requirements, but they are. A lot of lenders have raised their minimum credit score from 5 or 580 to 620 to 640. I heard a major bank raise their FHA to 660 this past week. So it just depends on the lender. These are called overlays. These aren't agency changes, these are lender changes. And as their liquidity risk increases or decreases, they're going to continue to move the needle on mortgage requirements. So again, it's crucial that anybody that's pre-approved reach out to the lender and make sure that they're still pre-approved under their new guidelines, especially if they're about to put in an offer. The only other thing I can tell you is verification of employments. Most lenders have gone to 3 days prior to closing to do a final verification. Some lenders have gone to the day of closing. And if the buyer's if you're at a closing and your lender can't verify your employment, they're not going to complete the closing. So it's very important that the borrowers get involved, make sure that the HR or their supervisors know that the lender is going to reach out so they can get their employment verified. Otherwise, they're not going to close. So again, I'm trying to keep up with what everybody else is doing. I've got a lot of friends in the business that work for different companies, and it's really all over the map. So stay in touch with your lender. Every borrower stay in touch with their lenders even after the purchase agreement gets approved and goes in. Even if they're in process, just everybody make sure that everybody's still on the same page. Need anything, give me a call, 248-705-8431, and please stay safe.